fantástico, fantástico. Es difícil calmar una multitud en Madrid. Okay, so welcome everyone. I'm German Zettelmeier. I'm the director of Bruegel, and I'm super grateful we can be here for our 20th anniversary. So this is the show before the show, so to speak. Has a big tradition in Spanish theater. Before the curtain raises, you're going to see something going on in front of the curtain, and the star of the show before the show is Paula Conte, of course, the Secretary General of the Spanish Treasury after a very long and distinguished career, and also a board member of Bruegel. And so, you know, we are always super happy at Bruegel to have, you know, the bosses of the Spanish treasuries as our board members that normally go on to become ministers. So we're going to make a tradition of that. So Paula is going to say something of substance on the theme of the event that we will have today, which is about sustainability and insurability, or problems with insurance. And so I'm sort of, I guess, technically going to chair while she's speaking. Then I may try and somehow transition to the main panel, and then the main show will begin. Paula, please.
Well, good afternoon to everyone. Thank you, German. Thank you to all the representatives and members of Bruegel that are here today, to all the guests, with a special mention to those that are following us online from across Europe. And I have to say that it's a real pleasure to welcome you to Madrid today and to be hosting on behalf here of the Spanish Ministry of Economy, Business and Trade, such a special event that celebrates the 20th anniversary of Bruegel. This is a very special occasion because it's an opportunity not only to celebrate the remarkable journey that Bruegel has led to become one of the most reputed think tanks in Europe over the past 20 years, but it's also an opportunity to reflect on the vital role that it plays in shaping the European economic conversation and in actually spurring policy debates through the organization of countless events like this one, the publication of innumerable papers, and as well the participation in key discussions. Most notably, recently I had the privilege as well of participating in them in the informal ECOFIN discussions on the issue of defense and the national reform and productivity. Of course, going over the many achievements and contributions of Bruegel in my allotted 10 minutes would be impossible, so allow me to summarize in just a few words to say that, in short, I think Bruegel has become a reference point for academics, for policymakers, and for institutions across Europe. And I think it's only fair to say that it has very satisfactorily met the mandate that it set out to achieve when it was created, which was to strengthen Europe's capacity to actually design and implement sound economic policies through independent and high-quality research. And I think that's something that has been very much achieved and that we should all be very grateful for. And I'm proud to say that Spain has also been a committed partner in this journey. Our institutions have actively engaged and benefited from Bruegel's work. Our experts have participated in research and governance. As Dermot was saying, I have the privilege of being on the board, but I'm not the first one, and other members are joining us here today. And over the years, this dialogue has enriched our national policy debates and also brought us closer to Europe. So it's definitely, again, a very vital role to highlight. But this anniversary is not only a time to look back. This anniversary is also an opportunity to look forward, because now more than ever in the next 20 years, we can imagine that we're going to need even closer cooperation between member states, between institutions, and between civil society, which is something that Bruegel brings in together so well. And we're going to need much more spaces for informed debate, for closer collaboration, and for policy innovation. And we're definitely going to need more than ever the voices like Bruegel that are independent, constructive, and very much committed to the European project. And because here, as we gather here today, and this has been something that has been going on for a while, but Europe faces an increasingly demanding agenda, where we have to ensure fiscal sustainability while we invest in competitiveness. We have to accelerate the green and digital transitions, and we have to do all that in a situation where we're navigating a very evolving geopolitical landscape. And among these many challenges that we face, climate change is one that definitely stands out, not only because of its urgency, but also because of its systemic nature. And to tackle this challenge, we need a joint effort from public authorities and from the private sector, with the financial actors and the markets playing a very central role from two very different perspectives. On the one hand, we need the financial sector to channel and to mobilize the necessary resource to mitigate climate change and undertake sustainable and transformative projects. And on the other, we also need actors that address the growing risks that are stemming from climate-related threats that are increasingly impactful. And notably, this is being done through insurance mechanisms and backstops. Discussions in the two panels today, I'm sure, will deepen our understanding of these two topics. And the event today will enrich the list of the many valuable contributions that Bruegel has done to advance progress in a key area at a critical juncture. Because at this time in which jurisdictions, some of them may be shifting their focus from sustainability and away from the fight against climate change, Europe, and Spain within it, remains very steadfast in its commitment to a sustainable economic model. Indeed, today we stand firmer than ever in our conviction that sustainability at the heart of decision-making and governance is and will be a key driver of Europeans' competitiveness, fostering innovation, building resilience, and supporting long-term performance, with the development of sustainable finance playing a pivotal role in channeling resources to key investments. In this context, the main responsibility of public authorities is to define shared standards and common goals, ambitious but achievable, that help align the actions of all market participants, building trust and credibility, and contributing to better informed decision-making. Over the past few years, as we had the opportunity to discuss at lunch with the many experts around the table, the EU has developed an extensive sustainable finance framework to support this objective. And the Omnibus proposal that was presented earlier this year has reignited the debate on how best to meet our sustainability goals more efficiently and effectively. In these discussions, Spain has fully supported simplification efforts that safeguard the competitiveness of our companies and minimize reporting burdens, but without compromising the integrity and the ambition of the framework or taking any steps back in the achievements, in what we have already achieved. As you know, the trilogues have to take place and the discussion will continue, but I very much look forward to what the experts will have to say in the first panel regarding whether or not they consider we are on the right track. What I'm sure they will definitely all agree on is on the importance of public-private cooperation going forward. And this is something we are leading with example here in Spain with the launch of the Sustainable Finance Council. This is a public-private forum that brings together regulators, supervisors, businesses, financial institutions, and sustainability experts to support companies in the green transition with a special focus on SMEs. The Council builds on the work of the Green Book on Sustainable Finance, which was published by the Ministry of Economy last December, and identified concrete, practical actions which the Council is tasked with implementing and advancing. Among its recent achievements and projects are the creation of a regulatory working group to monitor EU developments and ensure Spain's voice is heard in key policy debates, the development of educational resources and a digital platform for SMEs that offers a database of regulation, templates, and examples of best practices to support reporting obligations, the publication of sector-specific guidelines for the green transition that is prepared in partnership with industry associations, the mapping of green financial products, the design of sustainability sandbox, and a long list of actions that hopes to help assess risks and advance on metrics for impact and climate risk. These are only a few examples of the key work being done in addressing the economic transition. But despite all these efforts, the effects of climate change are already unfolding, and they extend far beyond environmental degradation or the tragic human suffering that is caused by extreme events. Climate change is also an economic challenge with very relevant macroeconomic, fiscal, and financial implications. As an integral part of our financial system, the insurance sector has a very important role to play in mitigating the economic risks associated with climate change. However, the private sector alone does not provide enough coverage, resulting in growing insurance protection gaps. That is, the share of losses from natural disasters that remains uninsured. In the EU, this gap is estimated around 80% for climate-related disasters, according to the ECB and EIOPA. As a result, when catastrophe strikes, citizens face uncertainty, and governments are often faced with a very significant financial burden. Here, public-private partnerships can once again provide effective solutions to overcome market failures. And Spain offers a very inspiring example, which is the Consorcio de Compensación de Seguros, the Insurance Compensation Consortium, with Paco's permission. This consortium, established more than 70 years ago, covers extraordinary risks typically excluded from standard insurance policies, such as natural catastrophes, and operates on a solidarity-based model. All policyholders contribute a small surcharge on their premiums to create a collective fund that guarantees compensation when extraordinary events occur. By pooling risks across the entire economy, the consortium reduces the insurance gap and the fiscal burden, and has proven an invaluable asset in episodes such as the devastating Dana floods in Valencia last year, when it mobilized swiftly to assess damages and compensate affected families and businesses with 3.5 billion euros dispersed to date. This rapid response not only helped mitigate economic losses, but also reinforced public trust in the insurance system. Looking ahead, as climate risks become increasingly systemic and cross-border, and market solutions dwindle, exploring European-level mechanisms inspired in instruments such as the consortium has never been more important. While the exact design remains open, the guiding principle should be clear: solidarity, shared responsibility, and financial resilience. But I am sure that this afternoon's panelists will have much more to say in this regard, so I will leave the discussion to the experts. Let me conclude by showing my sincere appreciation to Bruegel for 20 years of excellence and unwavering commitment to the European project. Your work continues to shape policy and enrich public debate across the continent. To all the speakers and panelists joining us today, thanks for sharing your expertise and perspectives on one of the most urgent challenges of our time, building a climate resilience Europe. And finally, to all of you here in Madrid and online, for your engagement and your commitment to advancing a more sustainable, competitive, and resilient European economy. Thank you very much.
Okay, so for me, there's a little more to do than to thank Paula and maybe say 3 words that, if you like, provide a transition to the panel. So, yes, thank you. So thank you so much, Paula, for your extremely kind words and also insightful words. And so my role is really to lead over to the panel and explain why this is an important topic for us and why we chose it. So you already mentioned arguably the most important one, which is we do want to set a signal that sustainability and both fight against and adaptation to climate change is and should remain at the top of the agenda. Second, it was without doubt the natural topic to pick for our event in Spain for 2 rather different reasons. One is that Spain, of course, is at the forefront of climate-related risks, but importantly, it is also at the forefront of finding solutions to these risks, and particularly through the role of the private sector. So Spain has tremendous companies that take sustainability very seriously and that are at the heart of sustainable finance, and most of them, I'm happy to say, are members of Bruegel, and you will see several of them in action on the podium later. And the other reason why this is a great topic is because it is possible to throw your hands up and be somewhat cynical about the inevitability of climate change, particularly since, European emissions play a small and shrinking role, right? So some of this is going to be out of our hands, not on the adaptation front, but on the mitigation front. I still think, Europe could do a lot more internationally also, outside our borders, to reduce emissions, and some of the recent Bruegel work has gone in this direction, particularly a report we published in July with the CEPR, the Center for Economic Policy Research, to effectively point to forms in which international climate action can be accelerated, even in a setting where the United States is not just missing, but actively opposing this agenda. So there is more that Europe can do internationally. However, what we're discussing today is not about that. So what we're discussing today are particular parts of this agenda which are entirely in our hands, right? And that's true for both panels. We have full control over whether we want to make, sustainable finance smarter, less burdensome, more effective. We have full control over insurance regulation, how we want to address this trade-off between getting the incentives right, making sure that no one is left behind, sharing the burdens equally or fairly. And so this is very much sort of at the heart of what I think, think tanks and, internal policy think tanks like the Spanish Treasury, which is what it is effectively, can do together, right? This is where, in a sense, academically based, somewhat technocratic thinking can make a difference. And so I'm super looking forward to what these two panels will give. I would just suggest now perhaps the first panel to come to the podium, and then Heather will introduce. Please come up.
Good afternoon, everybody. Welcome to this first panel. I'm Heather Graby, Senior Fellow at Bruegel. It's a great pleasure for all of us to be here. We've had a great introduction to this topic, and we're going to pursue it with vigor. We have a fantastic range of expertise here, and I think some at least nuances of opinion where you won't hear the same views from each speaker, which is as it should be at a Bruegel event. So we're going to talk about sustainable finance for a competitive Europe. So this is about the current events. So issues like, is the omnibus process on track for revising the sustainable finance framework, as Paula mentioned? Is this method going to deliver the results promised? We're going to talk also in terms of the current situation with regard to how investors and the investment community are experiencing data gaps, and what kinds of confidence and other sources of data they need in order to make green investments. And also, we will think about, looking forward, how should the EU position itself in a turbulent global context where the US government has fundamentally changed the incentives and the constraints facing the financial sector in the United States, and that, of course, has a big impact on global markets. And then long term, of course, we need to think about the issues of competitiveness and resilience and how sustainable finance can play a role there, but also the tensions between those two objectives, which are very evident in all of this area. So we're going to start with a presentation by my colleague Silvia Merler. She's a non-resident fellow at Bruegel and has written a number of very interesting papers on sustainable finance, which are available at bruegel.org. She's also a market participant and knows the market very well as the head of research at Algebris. Then we will move on to three perspectives from the Spanish Treasury, from Iberdrola, and also from BBVA Group. So we'll get quite a range of different public and private sector expertise. So Silvia, would you like to start?
Yes, thank you very much. So I should have a presentation, which is not that one. but while we pull that presentation up, I'm going to say a few things about the presentation so we can stick to the time constraints. So the whole idea was there was a dominant theme in sustainable finance. There it is, thank you. There was a dominant theme in sustainable finance over the past year, and that theme was transatlantic divergence in terms of climate commitments and sustainable finance and what this is going to mean for the market, for sustainability, regulation, and for investment going forward. So what I'm trying to do here is to start to quantify this phenomenon, so to try and understand whether we are seeing this divergence and what is the extent of it, at least in the data. And I'm going to try to be very, very short, but what you will see across this presentation is basically 3 facts. Fact number 1 is that Europe leads in all possible measures when it comes to sustainable finance, developing the market, bringing regulation, and also in terms of sustainable issuance. Fact number 2 is that the US, and this is probably not surprising, in North America in general, lags on all of the above. And fact number 3, which I think is the most interesting one, is that while we have not seen a significant scale back in Europe so far, we do see signs that may be worrying. So we do see signs of at least a slowdown in terms of how things were going just up until a year ago. So if I could get my first chart up. Yes. So this is obviously something that was in the news very prominently. So you may have seen a lot of discussions around backlash against quote-unquote woke capitalism in the United States and pretty much everything related to ESG and sustainable finance in general. So what we try to do here is to quantify sort of like the extent of this phenomenon. We look at around 200 financial institutions across the banking, capital market, and insurance sectors, representing about 13 trillion in market cap. So this is a very good proxy for the sector. At the peak of what we could call the golden age of sustainable finance commitments, 60% of this more than 1 trillion assets were managed or held by financial market participants who were members to sector-specific net zero alliances, committing to decarbonize their loan book, their portfolio, their insurance portfolio, depending on what sector we're talking about. In the past year, this has dropped dramatically in North America, which is mostly the US, but not just. Also in Canada, and you can see that very clearly on that chart. Europe is obviously way ahead when it comes to financial sector's commitment to decarbonize financed emissions, but we have seen some institutions withdrawing from alliances in Europe as well, so something to definitely be monitored. Similarly, if I can move to slide 2, similar picture coming from looking specifically at decarbonization targets that the same institutions have in place. So when we look at the global level, about 8% of the assets of the group that I was mentioning earlier do have a science-based emission reduction target in place, and an additional 8% have a commitment to set that target within 2 years, which is important. Europe's clearly way ahead on this metric as well, as you can see on that chart, but we have started to see institutions dropping or withdrawing or removing their SBTs over the past year, and that has happened not just in the US, but in Europe as well, to a, in my personal opinion, worrying amount, particularly across the banking sector, but not only. So this is also another metric where Europe clearly leads, but there are potentially reasons for concerns. Moving on. When we look specifically at the loan book, so this is only banks, our banks catching up in financing clean energy compared to fossil fuels. We know that to be able to meet decarbonization commitment at the full economy level, we need funding of low carbon energy supply to significantly exceed funding of fossil fuel-based energy by almost 4 times, actually, according to estimates. And we're not yet getting there. So again, Europe leads. It's the only jurisdiction where banks finance more low carbon energy supply compared to fossil fuel. Nowhere else in the world this ratio is equal to 1, but there has been a slowdown between 2023 and 2024 that you don't see in this chart, but if I were to plot 2023, you would see that the strong increase we have seen over the past few years has slowed down and stalled a little bit. Incidentally, North America is the only jurisdiction where this ratio has gone down over the past 4 years. So once again, the facts that I was mentioning earlier. So we keep seeing constantly this, regularity looking at the data. Looking at CapEx, so this is instead investors, not just banks. It can be asset managers, it's investment funds. When we look at CapEx that goes to low carbon energy supply compared to fossil fuels, right now, on a global level, we get $2 invested in fossils per every single dollar invested in clean energy sources. So that's definitely not where we should be. And once again, Europe is ahead. But here, I would say the thing that really matters is how the market is structured. So when we look at large US passive funds, for example, which are obviously very big in terms of the size of the asset that they manage, they enabled almost 70% of all the total CapEx investment that is covered in this data. But most of them have very, very low ratio of funding low carbon energy compared to fossil fuels, far below 1%, actually far below 0.5. So what this is saying is that a lot of money goes into investments that are not really geared towards fostering the sustainability transition. Now, when we look at European funds, and this is where regulation, I think, we can see that there is an interesting effect of regulation. Regulation in Europe distinguishes between different types of investment funds according to their sustainability features. Those funds that are sustainable, so only doing sustainable investments, they have a much, much higher ratio of funding low carbon energy capex compared to fossil fuels in the order of 8. So $8 going into low carbon energy compared to $1 of fossil fuel funding, which is really very significant. The problem with that is that unfortunately this is a very small market, even when it comes to Europe. So sustainable funds, EU investment funds, are only 4% approximately of all the investment funds that are marketed in Europe, and less than 1% of all the funds globally. And the niche is actually growing smaller because unfortunately we have seen constant outflows over the past 2 years from Article 9 sustainable funds in the European market. We can then discuss what the reasons might be, but I'm not going to spend too much time on this now. Looking at the corporate side of things, one topic that everybody loves to talk about is green bonds, obviously. So green bond issuance is very strong in Europe. It has been very strong over the past few years, but it has slowed down in 2025. Now we're obviously in Q3, so there will likely be an uptick in the next 3 months. We'll have to see what the year-end number will look like. It's probably going to be higher. But when we look at the share of green bonds as a share of total corporate bond issuance by European companies, it used to be above 10%. It's now in the order of 6%. It may grow before year end, but last year it was 9%. So it's sort of like not really picking up speed in that respect, and it seems it's a little bit slowing down. When we then restrict the focus even further to those bonds that would qualify to bear the EU Green Bond label that was introduced in 2024, and that requires very, very strict standards on taxonomy, use of proceeds. The market is even smaller, right? So taxonomy-aligned bonds are, in 2025, represent approximately 7% of all green bonds issued by European companies, which means it's less than 1% of total EU corporate bond issuance. Very, very, very small. And probably don't need to say that, but more than 80% of those bonds are issued by companies in the EU, so it's not really becoming yet a global standard setting mechanism. Those bonds are also very concentrated from a sector standpoint, so more than 80% of the outstanding taxonomy-aligned green bonds are issued in one single sector in the economy, which is utilities. And issuance is marginal in the other sectors, especially in sectors where the decarbonization is more complex. So industrials, consumer goods, manufacturing, companies in those sectors don't issue taxonomy-aligned green bonds. There's a number of reasons for this, partly linked to the fact that the taxonomy is not really a good framework for transition finance, more for identifying what is already sustainable. We can talk about that. But mostly because of also complexity to sort of align and categorize projects in sectors different from utilities and meet the very, very strict do no significant harms requirement. And I'm sure we will talk about that in the context of the omnibus discussion. Moving on and related, when we look at the taxonomy alignment of investment funds, which, as I showed earlier, are very important when it comes to funding clean energy compared to fossil fuels in the European market, most of these funds actually don't use the taxonomy to define what is environmentally sustainable. So most sustainable investment funds in Europe do commit to invest in environmentally sustainable activities, but almost none define environmentally sustainable using the taxonomy. Actually, the median commitment is 0% when it comes to commit to invest in taxonomy-aligned activity. And this is the result of things that I showed you in the previous slide. So very strong concentration from the sector perspective, very narrow market in taxonomy bonds, and so on and so forth. But obviously, not helping the taxonomy to establish itself as a framework for sustainable finance in Europe, and then obviously, consequently, more broadly at the global level. So coming to a conclusion, so I don't want to take too much of our time. Once again, the messages from these presentations are very simple. Europe is in the leadership position when it comes to sustainable finance. Jurisdictions that we're working towards catching up are apparently no longer interested to do so, at least following recent political developments. But we start seeing signs of things that could be weakening the European leadership in these sectors, and I showed some of that in the data, but also, more importantly, and to then move on to the second part of the discussion, on the regulatory side, we have seen a lot of lack of clarity. So particularly with the recent omnibus proposals, there's been a complete reversal of what both corporates and financial market participants were expecting in terms of regulatory certainty around sustainability and sustainable finance. And this, I believe, is really the most important risk when it comes to potentially losing this leadership position that Europe has worked so hard to build up to this point. And I'll stop there.
Thank you very much, Silvia. Fantastic to have that overview and reality check, particularly with the data on what's happened, not just this year, but actually over the past 2 years. The change in expectations in the market and the degree of capital outflow is pretty striking. So now we're going to have a perspective from the Spanish Treasury about the regulatory side. particularly the EU, the omnibus process, whether it will result in a coherent EU framework for sustainable finance, and also the challenges foreseen by policymakers regarding what data are going to be available at the end of the omnibus process, how to do risk management, especially when a lot of the physical transition, the physical risks don't seem to be priced into markets. That's something we can come on to. Transition risk is better understood, better quantified than physical risk. And also the whole question of volume of transactions, so the demand side as well as the supply side. So Ana Puente is the Deputy Director for Sustainable and Digital Finance at the Treasury. What do you think about the regulatory side at this time?
Thank you so much, Heather. Thank you, everyone. Well, in my view, whatever the result of the trialogue is, the European framework for sustainable finance will be complete, will be reliable, will be robust enough to keep improving the situation. I think that we must not forget where we are. The fundamental pillars of the framework are there, are well designed, and are not being, let's say, reviewed in their roots and in their main adequate features. We have a taxonomy that is science-based, is absolutely reliable, is not a subjective one, and it will work. Of course, we welcome the streamlining of the do not significant harm criteria, but the taxonomy is there, and it's a tremendous good tool. We have specific tools, products. We have the European Green Bond Standard, we have ESG ratings regulation that helps, and we have a disclosure obligation. So the framework itself, it's a good one, and it will be after Omnibus. Of course, we welcome the objectives of the European Commission on simplification and competitiveness. There's no doubt that the sustainable finance framework has room for improvement. It must be fine-tuned. We started with disclosure obligation for financial sector without having a taxonomy and without having any data for companies. So, of course, the framework must be fine-tuned, must be adjusted. This exercise of simplification and competitiveness is not easy at all. It's clear from the very beginning, and the European Commission expressed it without any doubt, we are not giving up our objectives. We need to do this exercise preserving the role of the financial sector, channeling all this finance for sustainable activities. We need to preserve and maintain the leadership of the European Union at a global level. And of course, we need to advance in assessing climate risk. Assessing climate risk from a corporate point of view and also from a financial point of view, financial impacts of climate risk, transition risk, and physical risk. And combining these objectives with an analysis and an exercise of reviewing obligations and identifying those of ones are maybe not so needed, or maybe the cost of compliance with is not compensated with the benefits, and also to analyze this obligation and try to find another way to comply with is not an easy task. So in general terms, we favor, of course, the exercise. It's not easy. Now I will go straight to the point of concern, that is the thresholds in the Omnibus Directive and the scope of the obligations of the reporting. One of the consensus, I think, here in Spain is that the legal framework of sustainable finance in the European Union has brought lots of positive effects. First, the whole financial sector completely embedded with sustainable finance at a structural level, cultural level. Green bond markets was there before 2018, but the main change in corporates, in companies, and in financial sector came with regulation. The same we can say for big corporates that find finance in capital markets. They adapted to the new reality. But then we have those companies, banking finance, that maybe we are not there. So sustainable finance is not an end in itself. It's a way to transform our economy. The Secretary General explained it really well at the beginning. So we need to go, let's say, down the ladder to SMEs, to the whole economy. So if we reduce the scope and we end up with few companies disclosing a lot of data points, but we don't use the value chain, we don't use the capability of those big companies to track on the rest of the economy, maybe we are losing a good tool for improving the situation. Maybe it could have been better to have more companies disclosing with a mid-cap category or without a mid-cap category, and disclosing just 20 data points, 25 data points. Within one of the working groups of the Sustainable Finance Council in Spain, we have identified, I think there are 25, 27, I don't remember really well, data points based on other works, on other examples, and they are quite similar, or the same as the EFRAG proposal for the voluntary disclosures for SMEs. If we focus on those data points, we try to standardize exactly what we want for each data point that covers greenhouse gas emissions, of course, water consumption, energy efficiency, 2 or 3 more elements, maybe that could be more useful for the whole economy to be transformed and for the dialogue between financial sector and companies to improve the situation. We have been defending this at the Council. We expect the best of the trialogues, and if the thresholds are still as high as they are proposed, we need to focus on incentives for doing this exercise of information, self-assessment, and the best, let's say, competitiveness position for our companies. I will stop here. Okay.
Thank you, that's terrific. Anna, one quick follow-up question on this. Are you concerned that, in fact, what could happen is that companies that are below the threshold, especially if they remain very high, may find that they still have a significant reporting burden because investors and indeed companies from which they wish to win contracts ask them for data in a non-standard format, that they end up having to provide a set of data points, instead of providing one set of data points to everyone under a standardized framework, they end up having to provide more ad hoc data to a number of different market players in order to maintain their position.
Well, I'm not an expert and I'm not a market practitioner, okay? But I guess that what an investor asks for maybe is not the complete set of ESRs as we understand it right now, okay? So that's the first point. One company may complain, but I'm sure that it's not the same. Another element could be once your investors or once your let's say, your stakeholders know that you have done the effort, maybe they will still need that data, but they need it. We need that data. So hopefully, once again, have this common data set of data, and then to enlarge it at the extent needed by a specific company in a specific sector or a specific company seeking for specific financing for any part of the financial sector, well, the market will develop and regulators will look at it and will adapt and will intervene if it's needed. But I think that, of course, the legal framework itself and the supervisory obligations, the obligations that are going to be supervised must be reviewed. But I don't think that the market participants ask exactly for the same.
Okay, great, thank you very much. So now we're going to come to company perspective. Sylvia reminded us that 80% of green bond issuance is by utilities so far in Europe. So we're going to come to the perspective of Iberdrola. We're lucky we have Guillermo Colino Salazar, Head of Debt Capital Markets at Iberdrola. So how do you see the state of the market in sustainable finance following the rather turbulent recent changes in the political context? Do you see that has an impact on the transition in different sectors as well as in different parts of the European economy? Is that something that you're already seeing on the ground?
Okay. Well, first of all, thank you very much for the invitation. Happy anniversary to Bruegel, and it's a honor to be at this ministry for me. I think it's the easy role or position for me because, as you mentioned, I represent a utility, and I think that it's the sector for which this is easier to do, right? I want also to say that I totally agree with what you both have said, with the diagnosis you have done, and with your reflections. As I see this, is that there are, in terms of sustainable finance, in my view, there are three big pillars. A couple of them is to do with the reporting, both from corporate side, the CSRD, and what we have already discussed. I'm not an expert on that, but as far as I'm concerned, I do believe we need some simplification of what we are doing, and because there are some big topics that are not so easy to report, and not only for small and medium enterprises, but also for the bigger ones, such as the disclosure of all your financial risks when it comes to climate change risks, and also the difficulties we may face to get all the value chain. I do the abstract that is like the scope 3 for emissions, but for everything you need to report under your sustainability report. And it's a kind of saying that if we were to do the financial statements, that you need to report the EBITDA of all your value chain, which is something really difficult for companies to know and to determine. So I think there is some room to improve there in terms of simplicity and flexibility. Then the second pillar, also regarding reporting, is for the investor side, the sustainable finance reporting disclosure, and I think this is also under revision. We have a challenge here, and I agree with your analysis, that investors have kind of gone away of this Article 9. They are not demanding Article 9 funds, and I think that's, I don't have the answer or the key, but I think it's one of the challenges we need to face, and to try to take investors back to this Article 9 funds demand. And there, the third pillar, which is what I can talk more about, is the regulation itself of the labeling or the finance. And there, maybe it's not a complete view, but I am quite optimistic. I think we think we already have all the rules we need. We did have them before EU Green Bond Standard. We have been based on the ICMA principles that have been great, have proven to work well in the markets. Investors like them. There have been developments of these principles. I think nowadays it is quite clear that investors prefer the use of proceeds approach. Investors want to see projects, and this is working well. And maybe what we were lacking of was to define what was green, and then the taxonomy came to say that. And I think the taxonomy, well, probably is not perfect, but is great. And it must be stringent, because I think the purpose of the taxonomy is not to say that everyone needs to do this at 100%, but where we want to be in 10 years' time, so where the CapEx must be placed in for the coming 10 years. And with these regards, we have the derivative of this, which has been the European Green Bond Standard, which is already here. It combines the best of both worlds, the ICMA Green Bond principles together with the European Union taxonomy, and I think that's really robust label for both for issuers to grant they are doing things well, and both for investors to grant that they are investing in what they really want to. This is already well verified by external verifiers that need to be under ESMA scope. So I think we have closed the circle. And well, now let me do some marketing of the company I belong to. But we've been doing green financing since 2014. I think it's achievable. I think it's for worth. We think it's what we call a virtuous circle. Last week we presented our strategic plan update, and we are investing 58 billion in the coming 3 years. Out of those, 90% is going to be aligned with European taxonomy. So the utility sector is already there. And this makes us quite easy to finance under these labels. We have the commitment to do more than 30 billion euros of green financing during these 3 years. And it's something we've been doing since 2014. Since 2016, all our public transactions have been in green format, with some exceptions for mergers and acquisitions transactions. We have developed the instrument, the original green bond, to other types of green financing, other type of instruments, other type of sustainable instruments, not only green. And an important thing we have done, and I don't know who said that, but I like as well, we have been doing like a truck effect in other subsidiaries we have along the group. Like, for example, our US subsidiaries, when they come to the market to issue debt, or the Brazilian companies we have, we can say that we have used the EU taxonomy approach in one of our US subsidiary green financing framework as an eligibility criteria. And well, all in all, I think rules are there, are working well, and issuers have the tools to use them when needed.
Thank you very much. And given that electrification is perhaps the great big challenge that all of the utilities are facing, is the current framework adequate for that? Does it provide the access to capital that's going to be needed for such a large scale of investment to make electrification work?
Yeah, I think for us, electrification is the key element, not only because of the fight against climate change, that for sure, but we are talking also about energy independence. We are talking about security in the provision of energy interconnections, and we are talking about affordability, cheaper energy, and competitiveness for Europe, which are topics that Bruegel is very keen on. So the capital is there. My main concern, or what I think we are lacking of, is this Article 9 extra demand. We are not seeing demand there. I think investors don't want to disclose so much, so they feel more comfortable self-positioning as Article 9. And this is relevant because I think that would create what we call in the market the greenium. So at the end of the day, an incentive, this is something investors don't want to listen to, and I understand, because it's like a zero-sum game. But for issuers, it's going to be easier to get finance if we see that there is a cheaper cost. And this is going to be the easiest incentive. So we are chasing that. We experience that, depending on the moment, but execution of green deals is much better than those that are not green. This is something you can clearly see in the banking market, where transactions are few basis points cheaper because of doing it green. And in the market, it depends on the moment. But we have the experience that volatility in the secondary market of green transactions is less. The pricing usually is a better pricing because you can get access to a better execution with more, with higher order books, better oversubscription ratios, and this is what allows you to have a cheaper cost. And this is the incentive we need to provide to the market.
Thank you very much. So I'd like to turn last to you, Emilio, but not at all least, because it would be very helpful to have BBVA Group's view on all of this, particularly on the question of where are the gaps in the European framework for sustainable finance and how should they be filled. What do you think would give the market a boost at this point?
Yeah. Well, thanks, Heather. To have a better understanding of the bank's role and that we need to boost clean finance, we must assume that the transformation at the scale required will only happen if it makes economic sense. Companies, SMEs, households, all of them make their investments only if they are attractive, if they are profitable. So to make it happen, there are two preconditions, we can say, and one critical enabler. The first precondition would be technology, in order to reduce the green premium in all the activities required for a net zero economy. As highlighted by the IEA, around 55% of these technologies are already commercially viable and need an agile deployment at scale, but there is 45% of these technologies, for hard-to-abate sectors especially, that require innovation and support to move from startups and first-of-a-kind projects to large-scale commercialization. So the second precondition would be industry policy, promoting lead markets, demand signals with predictability and the right incentives from one side, targeting effective public financing mechanisms to de-risk clean tech, not only in the early stage, but mainly in the scale-up phase, simplifying processes and faster permitting, not only renewable projects, but also in biofuels, energy storage, hydrogen, CCUS, and strengthening public-private partnership as well, and leveraging industrial clusters through an ecosystem approach. So these two preconditions contribute to build the business case for investing in decarbonization, and then, last but not least, the critical enabler, which is finance. So our role as banks is to provide financial solutions, advisory services to our clients, whether they are corporates, SMEs, or whatever, to support them in their investment decisions, which they will only take if they are, as I said, profitable and if they are attractive to them.
Okay, thank you very much. I think everything that we've talked about so far in this panel, the great sainted Mario Draghi, because he has attained that status in Brussels, would agree with. And in fact, he spoke in Brussels the week before last and essentially said, you know, my prescription was right, but it's not being applied. And particularly on the financing side, he said, it's all about scale. So if we've got if we say we have the three pillars that you talked about, what would scale up the overall level of finance? Is it something that you expect will reach a critical mass and it will happen, or are we going to see continuing diminution of capital flowing into this? You know, as we saw, it's been really striking what's happened over the past year, as Sylvia presented it. Is it something where you see this is going to remain a niche market, still at just a few %, or is it something that will reach critical scale because the transition is inevitable?
We're optimistic about that, BBA, and if we can say sustainable finance should be the cornerstone or the backbone of Europe's future, as a cornerstone of Europe's long-term competitiveness, resilience, we will need on one front the Clean Industrial Deal, highlighting the urgency of mobilizing both public and private capital to accelerate industrial decarbonization, modernizing infrastructure, etc., and scale clean technologies as well. So clear regulatory frameworks, from hydrogen standards to CBAM reforms can help de-risk investment, attract private savings into strategic sectors such as steel, chemicals, or transport, for open site. At the same time, the deep science analysis underscores that Europe's innovation bottleneck lies not in research excellence, but in translating discoveries into market-ready products That I think is very important. So bridging this gap requires stronger equity financing, particularly science equity, deeper capital markets to channel risk capital into early stage high-tech ventures. So sustainable finance should therefore go beyond green bonds or climate-focused instruments. It must actively build the funding ecosystem that transforms scientific breakthroughs into industrial leadership.
That's definitely an amen that Draghi would be giving you. So I'm going to come to questions in the audience. Just while you're thinking about what you might want to ask this august panel, I just want to come back to Sylvia on the scale question. What hope do you see in terms of this moving on from 4% of the market? Is this a matter of maintaining the regulatory certainty, maintaining a clear sense that the transition is going to happen, and therefore investors' expectations will come back into line as they realise that Trump has not managed to kill the whole sustainable finance area? Or is it just something that's going to remain quite a niche market?
So I also want to be optimistic. I'm going to put on my financial market hat for a moment, because I wanted to try and answer the question of why there's little interest in Article 9 funds right now. And I think that has to do with two things. One is diversification, and the other one is performance. So to give you like an idea of the numbers, if we look at the Euro Stoxx 600, which is basically 90% of European market capitalization, and we look at the revenues of the companies that make up that index, the average taxonomy alignment of those revenues is 10%, which is really low. Among the companies that do have greater than zero alignment, the average is 27, which is still very low. So what does this mean? It means that if you want to do an Article 9 funds with a high taxonomy alignment, you are left to invest in very few sectors and very few companies within those sectors. So in other words, you do have to accept very high level of concentration, which is a risk from an investment standpoint. And here is where I come to performance. So if we look at 2023, which is when the outflow started in Article 9 funds, if you take the largest clean energy ETF in Europe, well, actually globally, ETF is a passive product that basically replicates the index of an underlying sector. So in this case, it would be clean energy company. So this has a very, very high underlying taxonomy alignment of the revenues of the companies in the index. It's above 60%, very high. Performance in 2023 was negative 20%. If you take the MSCI World, so an index that basically tracks the world, so not sector specific, but the Paris-aligned version, so a version where you do not have the high fossil fuel exposure that you would have in the non-Paris aligned version, performance was up 20%. So, summing up, Article 9 funds done in a way that achieves a very high taxonomy alignment in the portfolio are very risky from a performance standpoint. And I think probably this also burned a lot of underlying clients and retail investors and like institutional investors to see what happened over the past 2 years. Obviously, it was idiosyncratic. We had rates skyrocketing. And for companies that are capex intensive, like cleantech, that was obviously not anticipated, and it created a lot of troubles, impairments, and everything. But it also left a scar. And I think that sort of is a problem. So coming back to your question, I think fundamentally for scaling this, what we do need is the taxonomy to get spread outside of one sector, for green bond, taxonomy-aligned bond issuance to start happen outside of utilities, so in industrials, consumer goods, all the sectors of the economy really, because that will allow investors to diversify their taxonomy-aligned portfolios. And definitely simplification goes in that direction, but simplification is one thing. Scrapping 80% of the reporting requirement from the corporate space in Europe is a little more extreme than simplification, so that could backfire because it could leave investors without the necessary data that they need to do that assessment outside of companies where this is very clear and obvious, and sectors where this is very easy to do and to assess from the outside.
Oh, it's clear, and I totally agree. On your first comment, I think there is for sure a lack of supply. So it is very difficult to have a dedicated Article 9 fund when there are no Article 9 bonds. But my philosophical question is if there is a lack of supply because there is a lack of demand as well. So it's a kind of circle, no? I think if the demand were there, probably there would be more issuers. Because if issuers find the incentives, and the incentive is a cheaper cost, which at the end of the day I think is what this game is about, I think we would see more transactions.
Thank you. Let me please add a regulation supervision element to this discussion, and then hope and optimism message, okay? The first one, at the end of 2023, and I'm not sure if the CNMV, the Spanish supervisor, has updated or not that information, they published a very brief report on the performance of Article 8 and Article 9 in Spain, not on a profitability point of view, but from a regulatory point of view, and how were they complying with the objectives they had themselves committed with in the brochures of the funds, and the findings were okay. Well, we are on the path of improving information and improving the compliance with objectives. Some recommendations, so every single piece of all this is needed for scaling, for moving on. You are explaining really well what is happening on the investment side, but the management company must deal with the supervisor and with regulation. And the second message is, well, okay, the European Commission has announced a review of SFDR. We hope they listen to the industry, they listen to the need of reviewing not only Articles 8, 9, labels or whatever, but also the dialogue with capital markets investors and try to make the most out of people willing to invest in capital markets. So let's hope that hopefully things will be better, and we will contribute as much as we can with the reviews of FSDR. Thank you.
Okay. Yes, I mean, I think we're getting a very clear perspective that this show is not over for a long time yet. There are already a number of other regulatory omnibuses on the way. There's SFDR, but also, of course, there's going to be an environmental regulation one, and potentially others as well. So this period of uncertainty around the final shape of EU regulation is going to be with us for quite a while. So who would like to come in? You can be as nerdy as you like with your question. You can really go down into everything you ever wanted to know about Article 9 but were afraid to ask. You can also ask really nasty political questions about the omnibus because we have such great expertise here. Go ahead. Just remind us who you are. Yes.
So my name is Peter Sweetman. 35 years in finance. I was working at JP Morgan covering the Treasury when Manuel Conte was the director at the time. I've been thinking about these subjects for quite a bit. I'm also a member of the Sustainable Finance Committee. I'm delighted to be able to provide input to it. I sat on a panel like this in New York, the first time the Green Bond Standards ever mentioned you're, as I have been, sitting on the investment committee, making private equity investments or venture capital, seed investments and what have you, anybody who's been through the pain of a finance transaction knows just how much data you provide. Now you provide all that data and more, and electronic due diligence, etc. Why? Because you want the money that the organization, because you want to turn it into the investment in equity, you want to turn it into the factory you intend to build, you want to turn it into the economic benefits that are going to manifest in the country in which you're operating. So the reason why we have a requirement of data on financial institutions is so that those financial institutions can better manage the risks that come with their portfolios. So Anna said that we're looking to find and identify 25 elements of data that could be useful to financial instruments. When I was thinking about, so mortgages are pretty simple financial instruments, I think. Why? 7 trillion euros of mortgages outstanding currently in Europe. It's one of the most familiar financial instruments that exists. So one time, a while back, as an analyst, I was looking at the European data warehouse to see how many data points that there were usually provided for each mortgage by each customer. And including voluntary data points, the spreadsheet which I had as a result had around 120 data points. So again, it seems to me that we can figure out a number of data points that are reasonable to be provided, and this isn't about deregulation or rolling back, as you quite correctly said, the agenda. Because we can certainly, as others can, convert an unseen, non-GDP environmental asset into seeable production. That's clearly an option that's open to us. But of course, that doesn't come from the risk management perspective of transition climate and climate finance. So I'm going to finish. So the thing I haven't heard talk about is AI, because the rest of the time what I'm doing is I'm looking for positive things to bring to meetings like this. So earlier on this morning, I had just I guess randomly, among the many calls that I had a call from a German enterprise that purports to be able to give all financial institutions all the information that they would need about the environmental footprints of all of the SMEs that are in their portfolio as a result of the plethora of data that exists at a product level from life cycle assessments. As just one example, I met an AI company that said that within 18 months they had modeled every single building that exists in Germany using Google Maps. So I'm like, why on earth are these types of companies, of which I think there are hundreds across Europe and in America, not talking more to regulators to provide regulators with the transparency that currently exists in the world at large, so that we don't think of filling in application forms every time we think of providing data?
Sylvia.
Again, from probably a financial market perspective. So yes, we do see a lot of pitches on AI data gathering for sustainability reporting purposes. Some of these are aligned in terms of what they offer with what regulatory requirements would be. So my answer to the question would probably be that in some cases AI is still wrong, and I could elaborate on which cases and how I saw them, like specifically on specific companies, which I will not do here. But I think also it doesn't really substitute for what companies may want to disclose themselves in the way that they know their business, the way that they're able to map their business from the inside, compared to just like running a web scrape and putting it into an algo. So it can definitely help, I think, especially on companies that maybe are a little bit less used to provide information to investors, maybe because they're smaller or newer, early stages companies. But I would say from an investor perspective, at least nothing really beats the information that you can get from company reports and the knowledge that you can get from talking to management and understanding what is the reason behind certain investment or financing choices that they made.
What's the perspective of a bank?
Yeah, I can provide my views as a bank, as BBVA, and well, of course, we welcome all the efforts that are currently undertaken to simplify the framework, which is overly burdensome and complex, reducing data points, reducing scope of CSRD, etc. However, it's very important to keep in mind that these changes are going to have an impact on the data which is available on the market. So will put banks, financial institutions in general, in a very challenging situation. No? Banks need data to comply with their own reporting and supervisory obligations and to ensure the proper risk management. So if the data is not available in the markets, bank will have to obtain it through bilateral engagement with their clients. So this would add complexity and would mean no simplicity, which we are looking for. So in order to solve this problem, the European Union should make an assessment of the banking regulatory requirements and supervisory expectations and propose the necessary adjustments to ensure that it is aligned with the simplified sustainable finance framework.
Mm-hmm. Yeah, so the issue about comparability and getting the same data from everybody. I would imagine there are also GDPR issues on quite a lot of this data, but others may know about this. Could you pass the microphone forward to Alicia?
First, congrats. This was very interesting. Can you hear me? Yeah, great. So I have a question. I'm sure there's lots of issues that explain your worries, Silvia. But for me, there's a worry that was not included, but which I really want to highlight here, which is the demand, and in particular, demand from outside of Europe. So in a world where, I mean, think about you're talking about divergence in a way of issues. But what about divergence of demand? What about if the rest of the world, and I can think of, frankly, Asian investors that I kind of know. I mean, there used to be a time, and this is quite recent, where Japanese would only ask about ESG investment. This is no longer the case. So my question is, are we going to end up in a world where, so in a way it's kind of bifurcated. Okay, we believe in this, but this is for us to finance our own transition. If you look at, you had a few data there on China's green finance, and it's growing amazingly, but it's all domestic. Yeah. It's all domestic. So in a way they do it, but it's up to them to finance it. And they can, of course. But can we, I mean, my question is, can we do all of this if the foreign demand slows down for our issues? That's my question.
No, I think you're exactly right on that. And I do agree that another worry that I would see is insularity, so that the market is increasingly regional, if not even local, as China demonstrates within Asia, like more broadly. I think I don't have an obvious answer to that, except probably to say that at least as far as Europe is concerned, one obvious way to address that problem would be more integration of capital market. We talk about this. We've been talking about this forever. So it's sort of like the old refrain of capital market union and savings and investment union, and this is now being rebranded, but that is really important at the regional level, because also within this common market and common monetary union, we still have insularity on some of those metrics as well. And at the global level, I think that will largely depend on how the US will move going forward. That to me, given the size of the capital market, obviously, in the US, I think that's the number one question. That we'll have to see how long this trend, if this becomes really like a solidified trend going forward, or whether at some point there is a reversion.
So I don't have a question from the audience, so therefore I'm going to put in one of my own, which is about the other side of double materiality. We've been talking about sustainable finance as primarily being finance for a transition that is essentially voluntary, that we in Europe want to undertake for, the greater good of humanity. But there's going to be a huge need for finance, for adaptation, and for dealing with the physical problems of climate change. I don't need to remind anybody in Spain about that. And I wonder if that might change the outlook for sustainable finance markets as well. Because there's going to be a need both for more disclosure of physical risks, and we'll talk about that also in the next panel, because of a lack of availability and affordability for insurance. But there's going to be all kinds of other risk management needs where investors are going to need a lot more information from companies about their exposure to physical risks of different kinds. And meanwhile, treasuries like this one are going to have to be thinking a lot more about how to crowd in the private finance to support all kinds of technology for adaptation, as well as other forms of essentially transition in order to cope. So there we're moving from the voluntary transition to the enforced transition brought about by Mother Nature. So how might that change things? Because this is something which is not very far away. It's being felt already on the European continent. We're warming at twice the global average. The Mediterranean is experiencing 20% faster changes to its climate than other parts of the world. Is it likely, do you think, that the physical risk and the need for crowding in finance will drive this market in a different direction, no matter what Trump does and no matter what the urge towards simplification is about?
I will try, okay? First of all, I think that the knowledge about physical risk is not as widespread, and you said it at the beginning. And transition risk is, I think, more modelized and more standardized, and I think that we feel more comfortable talking, deciding, measuring transition risk rather than physical risk. But it's also difficult to analyze properly adaptation objectives that is not exactly the same as physical risk. So one thing is investing in adaptation, and another thing is, let's say, the financial impact of the materialization of physical risk. And sometimes it's mixed, and it's normal because there's not a widespread knowledge about physical risk. So I think that we still need standardization of methodologies, of understanding of definitions, and then we can separate well debates on how to focus on investments in adaptation and what is and for what, and all the problems that we have more or less solved or reached some kind of consensus around mitigation. And another thing is to tackle physical risk, identify it, to give social conscience around that, but it's the next panel in charge of it. Okay?
Well, maybe just to add that, I mean, at least from the way I see it, and this may be wrong, I tend to see investment in adaptation as being a lot more public, on the public side of things, for reasons that, well, in part because it obviously has to do with infrastructure, like the big building management project that the state is ultimately responsible for. But when we look at private sector, I think really we're not yet seeing investment in adaptation. What we're seeing is, so far, is transfer of risk via insurance, and we will talk about that in the second panel, which I think is an interesting development, but it is different than really readying your business for being like prepared for the consequences of climate change. That is different than just transferring the financial ownership of that risk onto a different subject. And so, relatedly, I think so far at least private sector involvement is limited to that. Yes, there is some securitization of these risks that we were discussing earlier, so some the climate catastrophe bonds, for example, and things like that, but it's like very niche still. So yeah, I think that market has to develop.
So you heard it here first. Let's see at Bruegel's 30th anniversary if we're having a panel about adaptation finance as a significant European market. So thanks very much to the panelists for a really interesting debate. I think you have 15 minutes now break. and then we'll do the next panel. Thank you very much.
Thank you.
Someone else should do it.
The super trooper lights.
Okay, thank you. Thanks everyone still here with us. I think we can move on to the second panel. Yes, we're actually 10 minutes late, so sorry for taking longer. I have the pleasure to be chairing this, and we will be hearing views on insurance and reinsurance. So the very last topic that we touched upon in panel 1. So this is a perfect actually complement to panel 1, and I'm very happy that we have excellent speakers to talk about this. Irene Monasterolo, who is a well-known academic and will offer her perspective on this from a macro, I would say, probably more top-down point of view. Maria Luisa Alvarez, who is Senior Advisor at the Directorate General for Insurance and Pension Funds at the Ministry, so also public perspective, very, very much welcome. Then we have Francisco Solano from the Insurance Compensation Consortium, and sorry if I don't say that in Spanish, my Spanish is really awful, so you don't want to hear it. And Bernard Meyer from the ESM. And as we were saying earlier, many people may be wondering why the ESM may be interested in insurance and reinsurance and topics related to climate change and physical risk, but there is a very good reason for that. So without further ado, not wasting time, Irene, would you like to start giving us your perspective?
Yeah, I've prepared a presentation, if you can put it on screen. No, it's not this one.
Brings back memories.
Yeah, that's this one, great. So I'm going to actually start from where... Okay, sorry, usually scream. Yeah, and so good afternoon, everybody. It's a pleasure to be here. And I'm going to start where Heather finished before. There was a question about adaptation finance. Adaptation is to finance investments aimed to build resilience to natural disasters. And in this regard, insurance and reinsurance are usually thought to be main tool as a backstop against climate physical risk, in particular acute physical risk, natural disasters from climate change like floods, droughts, storms. But there are several buts. So I was distracted. Please. Yeah. So let's look at why insurance could be our first thought and first choice when we talk about climate risk management tool. In this regard, we just published a review article that is the result of our European Commission SG reform project aimed to support national authorities, so financial regulators and central banks, on assessing also the climate insurance protection gap. So first is to limit economic losses from extreme weather events, and also on the long term when we look at their long-term cost, and limit the welfare impacts of climate-related natural disasters. Then there is a more public finance role, so to reduce public contingent liability, so the fiscal impacts from post-disaster reconstruction and relief program. There is also then an impact on private finance, so to limit the effects on interest rates and on asset prices volatility. And finally, to incentivize risk reduction by encouraging the adoption of adaptation measures, both at the micro and macro level, that could lower premium for insurance products and increase preparedness. So overall, when we talk about insurance role as a climate risk management tool, that's aimed to enhance economic and financial resilience to climate physical risk. However, here we come to another point that was briefly touched upon in the discussion before. Insurance is not there, and this is a major issue for economic and financial competitiveness for the European Union. So in Europe, according to the first report published by the European Central Bank and the EIOPA 2 years ago, the insurance protection gap, as shown by the figure 1, which is on my right here, is very large and heterogeneous across countries. Before was a mention of an average of 75 to 80%, where there are some large European economies, such as Italy, where the insurance protection gap is well above 95%. And this gap is growing because losses from extreme weather events are growing, and in the next few years, as recent short-term climate scenarios published by the Network for Green Financial System, losses will increase because the frequency of extreme weather events and their disruptiveness will also do. So in this context, if we don't have insurance, other financial services that are at the backbone of our economy, such as credit, may become costlier or unavailable. There might be higher risk, and so higher default probability of firms, lower value of collateral, which actually will lead banks to adjust their risk assessment and also to have adjustment in the level of their risky assets, and with all the issues on capital requirements. But also, if insurance is not available, this is a public finance problem, because the cost of reconstruction will fall on governments, meaning will fall on taxpayers, on households and firms, which are already paying for recovery from reconstruction in another way. So, and this could further strain public finance. We know that public finance in several EU member states, also those who used to be kind of virtuous, is not really shining. And also, so what you see then on the on my left, are the potential implications of physical risk, floods on the left side and dry events on the right side for banks. So banks are highly exposed to physical risk, and in absence of insurance, this exposure could translate into potential losses. So basically, the question here is, how much do we know in order to identify potential solutions to narrow the insurance protection gap? When we started this research, actually what we found out is that we knew very little, in particular for what concerns the supply side drivers of the insurance protection gap and the withstanding economic mechanism, and how they fit on actually sovereign and markets decision. So here what you see is a quite comprehensive figure where we have as blue boxes representing the supply side drivers of the gap, the yellow boxes representing the demand side drivers of the gap, green boxes representing potential markets intervention that are currently available or being explored to address the gap, and the purple boxes being the potential sovereign feedbacks of the gap. The red arrows are reinforcing feedbacks, meaning that the two variables connected co-move in the same direction. while the green lines represent balancing feedback, so two variables move in the opposite direction. Starting from the demand side, drivers of the gap, what we know from the literature and what we see also in several case studies we analyzed, which covered Spain, France, Italy, and Austria. Well, first is the charity hazard, we were discussing also before, so when government commits to pay fully after a disaster, actually firms or households have much lower incentives to take on an insurance. Another issue is low perception of risk, and this also emerged from a micro-level retail survey that we carried out in Italy. Another issue is policy affordability, so the affordability of the premia, which actually increase even when with disasters, when in the places when contracts are available, because in several countries contracts are not available. And another point is agents' information and financial literacy of farms and households that we surveyed, which is generally highly heterogeneous and generally also quite low when it comes to role of insurance in the context of natural disasters. What is also quite interesting to see, and as is usually less discussed, so I hope this could stimulate further debate here, are the supply-side drivers of the insurance protection gap. And this comes, why insurance companies actually face challenges in providing insurance against extreme weather events and natural disaster. One issue are the liquidity constraints that could lead to solvency constraints, and the issue is that extreme weather events are large and are becoming more systemic. Also, they tend not to occur in isolation, but to repeat themselves in the same area as time goes by. So this represents an issue for insurance companies. The second is, and connected to that, are capital constraints. Also, the issue is for insurance, there are little diversification opportunities in order to be able to manage such risk and be able to provide insurance also when when potential losses increase. And the last point is the definition of risk premia, which should be based on risk assessment. And in the context of climate change, such risk assessment should be forward-looking, looking also at the future, not only the past, because we know that the statistical distribution of risk will be very different as disasters get worse. But also in this regard, there are several challenges, as insurance companies mostly now rely on parametric insurance. So when these two elements combine, then we have usually low insurance uptake, what we saw both from the literature and from countries surveyed, except Spain. And the large bulk of the cost falls on sovereigns, and which in turn affect their sovereign credit risk and increase the cost of refinancing on markets. Now, here I also highlighted, just to be short, and some potential markets interventions that are available. In some countries, there are mandatory insurance schemes, public and private, with public usually being a reinsurer and private providing insurance. There are also instruments that were mentioned before, like catastrophe bonds and growing blended finance. What's also starting to take more attention is the design and governance of potential public and private joint solutions.
Thank you. Thank you for this very clear overview of also how systemic this issue really is. And as you said, well, the ultimate link in the chain of potential losses is the government. So I'm going to turn over to Maria Luisa for a public sector perspective, what public policy can do to mitigate these risks and also their financial consequences, with obviously a particular focus on Spain, where this is now an extremely important discussion.
So thank you very much. I'm going to start with my presentation. First of all, we want to say that sustainability is nothing new for the insurance sector. Maybe it's obvious, but we don't care if we call it sustainability or climate change. But the insurance sector has always included NatCat risks as one of the risks they are facing. So just imagine an insurance undertaking that they didn't assess wind risk, for example, or rain risk. So it doesn't make sense. So we don't care if we call it whatever we want, but those risks, they are a risk for insurance undertakings. In fact, our legal framework, the Solvency II regulation, that is our risk-based supervision, it already includes NatCat risks. So that's reflecting that, of course, sustainability was already included in our standard formula for assessing our risks. The good news, at least in our opinion, is that the insurance sector is one step ahead of other sectors because we already know those NatCat risks. And of course, in our case, the insurance undertakings must have enough own funds to cover, among others, NatCat risks. So they are covered in the standard formula, and of course, they are under review. At least each 5 years, EIOPA, with our collaboration, must review those NatCat risks and their recalibration. And the last recalibration has been approved a couple of months ago. So we are assessing those NatCat risks and we are recalibrating them. And of course, this situation could not be possible without the help of the Consorcio de Compensación de Seguros. In Spain is the best mitigation technique for insurance undertaking. I think it's one of our better institutions, so of course it's always needed to talk about them. In our insurance and pension fund supervision, we have created a new department for sustainability because we saw that there's a clear need of this department. And we review everything, solvency, CSRD, due diligence, taxonomy, SFDR, so everything regarding sustainability for insurance and pension funds, we review them. We try to assess the resilience of the insurance sector in Spain and in the pension funds. And of course, we have included sustainability as one of our supervisory priorities. I'm not going to explain to you how Solvency II works and how we have to change our mind for these sustainability risks, but just you can review that we have to assess how undertakings have included sustainability in their governance, in their underwriting area, reserving area, investments area, risk management task, actuarial function, remuneration policies, and prudent person principles. So in general, the whole insurance undertakings have been affected by sustainability. So that's why we think that it's a huge topic for us, talking about this sustainability. In fact, our delegated regulation has been modified in order to include these sustainability risks to take into account. And also, we are also including these modifications and sustainability risks in our directive. And I have started my presentation telling you that, of course, maybe we didn't call it sustainability, maybe we didn't call it climate change, but is it really important? Are we really affected by climate change? I'm not going to answer, but figures are going to answer. Claims paid due to extraordinary events in goods have increased during last years. Also, sum insured has a clear upward trend, so very good news because, of course, although claims are increasing, also the sum insured is also increasing, so very good news. Regarding personal damage, we didn't see that trend yet. And let's see the physical risks depending on the different types of risks. As you can see, here is a comparative analysis of data from 2022 to 2024. As you can see, wind and rain have increased their cost over the last 2 years, 59% and 28% respectively. Frequency also increases, 48% and 20%.
And the average cost, of course, hail is the highest, has the highest average cost, and it's increasing more than 15% in 2 years. Okay, let's have the same analysis depending on the lines of business of the insurance undertakings. As a summary, all the lines of business have suffered cost increases. Household, multi-risk, and industrial are the ones with higher costs, of course, but not only the cost is increasing, but also frequency is increasing in all the lines of business. And of course, regarding the average cost, industrial multi-risk is the second highest cost, but very small frequency, so the average cost is very high, and it's also increasing more than 10% in 2 years. So, as I told you, I'm not going to answer you if this topic is important for us. I think that figures are talking, and of course, NatCat risks are very important for the Spanish economy and for the Spanish insurance undertakings. We have also assessed different physical risks. I think that was the last question of previous table. So we were talking about physical risks, and it's also important to have a geolocalization of each physical risk. Why? Because, of course, insurance undertaking, they must geolocate their policies, so we can overlap some maps and to know exactly where do we have each physical risk. Obviously, we have, for example, the rain risk. We have the Dana in October. Of course, Valencia has the most important falling in and costs of rain during last year. But also, it's important and it's very useful because sometimes we don't realize that, for example, wind is very important in Madrid. So doing this assessment is very, very useful, at least in our opinion. And that's perfectly, and also with Irene's presentation previously, about the protection gap. In our opinion, protection gap is one of the most important indicators to be followed. It's necessary to convey the culture of the importance of insurance, but it's also necessary to facilitate this access to insurance. Maybe insurance undertakings, maybe they have to have more clear information. They must give clear information to policyholders. Maybe they must take into account some adaptation measures that they can take into account in order to maybe reduce some premiums in some places. But it's important to remember that without insurance, there is not coverage of ordinary risks or extraordinary risks. We were talking about the consortia, but the consortia is going to pay only if we have private insurance previously. So it's important to assess the protection gap, and it's important to reduce the protection gap. And also, don't forget that we have sustainability. This is not only climate change. We have S due to social. So please, we need to focus on this topic too. And we have assessed the protection gap in Spain and the national coverage property. We have near 83% of our properties are already insured in Spain. Of course, thanks in part to the one law that states that it's compulsory to have an insurance policy if we have a mortgage. And of course, where houses are expensive, we have even 90 or 95% of coverage. You can see here that's only 0.1 of protection gap. So that's, for example, Madrid or Catalonia with a very national coverage property very high. But just think about if we suffered an extraordinary event, not in Valencia, where we have near 90% of national coverage. Just imagine if we suffer some climate change catastrophe events in some places where we do not have this insurance penetration. So that's why we think it's very important to assess the national coverage. And it's not only important to know where we can increase the penetration of insurance, but it's also important to know which risks are those parts of Spain facing. So we have overlapped some maps regarding the protection gap and regarding some NatCat risks. For example, this is regarding wildfire. And we can see here, depending on each postal code of Spain, how many wildfires they are suffering and what's the probability of suffering additional floods, for example, in 10 years. We are trying to overlap those maps in order to know exactly the problem. So maybe we have some problems depending on each part of Spain. For example, I have, here you have just an example. In Calatayud, I told you that we have done this exercise for each coastal port. So, for example, they have suffered in the last 10 years 51 wildfires. But we have very good news, because the protection gap is only 18%. So more than 80% of the population in Calatayud is insured, has an insured policy. So that's very useful, at least for us, to know exactly where we have the problem, or if we have a problem or not. And the same analysis with overlapping maps with flood risk. The same place with a protection gap of just 18%, and they have a probability of suffering some floods of 50% in the next 10 years. Just imagine again that we have this probability in a town with a protection gap of 80%. That's to show you the magnitude of the problem that maybe we could have or not. And we are assessing not only the physical risks in our country, but also at an international level. Why? Because of course we have several insurance undertakings that have business in other countries, and we are also developing some IT tools in order to assess their physical risks. For example, this is the example for Brazil. And we will have here the business of some insurance undertakings, and we can see here the risk for extreme heat or coastal floods or wildfires or whatever. We are assessing each country in which our insurance undertakings have a business. And we are not only focusing on the present situation, but also we are taking into account the possible scenarios. We are using some SSPs or RCPs scenarios in order to assess the risk index for each country in which our insurance undertakings have business, and in order to know if they are really facing or not some climate risk changes. And we can, in order to know exactly the scenarios for 30 years and for 2080. And that was for non-life business, okay, but we also have our life business. And we need to assess the direct death due to heat. I will show you a map later. But also the deaths that are not directly caused by heat, because sometimes we have some deaths that would not have occurred if there had not been such high temperatures, even though there's not a direct effect of these heat temperatures. So this, of course, requires more complex statistical methodologies, because some illness are going to suffer due to heat, but it's necessary to assess these also direct and indirect effects or in mortality due to climate change. We have some examples regarding how we are assessing the life business, thanks to some information published by Instituto Carlos III, for example, that is going to give us special data for deaths due to heat. In Spain, during last year, or the period, whatever you choose, by age or by sex. And it's very useful because we can have another map, for example, just to know where people is dying more or less due to heat. Why? Because sometimes people are not dying more in the south because they are more prepared to heat waves. So sometimes the numbers tell us that we are not correct when we suppose something. And just to finish, not only we are not only assessing physical risks, but also transition risks, of course. We are using the classification of assets, taking into account NACE codes and Battiston assessment. We are trying to introduce little by little another assessment like transition plans or transition sustainability risks. And we are, in order to have a general picture of the assets that our insurance and pension funds have, if they are green, neutral, or pollutant. Then we can have the general picture of the whole sector. Of course, this is just an example. And we can know by issuer if it's considered green, neutral, or pollutant. And we have also applied some stress to our assets for insurance and pension funds, just to know if, to assess the resilience to these transition risks. So at last, we have several challenges due to climate change. Of course, to increase the relevance of insurance in our economies. To remember, it's very important to geolocate the insurance policies and risks. Insurance undertakings must assess the materiality assessment of the different risks, and they will need to quantify those losses. Of course, one of the main challenges is data availability and data quality, because of course it's not easy. We will need to develop some IT tools, and at last, protection gap, we will need to increase the relevance of insurance.
Thank you. Thank you for this very, very detailed presentation. Francisco, so we've heard a lot about why this topic has become so central, so prominent, let alone the fact that some countries are introducing mandates for insurance against climate risks. But what I wanted to ask to you is, where do we draw the line? So what can the private sector credibly and feasibly insure? Where do public sector backstops need to come in? How do you see this from the perspective of the insurance consortium in Spain, but also potentially with a European view?
Okay, well, thank you, and good afternoon, everyone. Yes, we have been quite the elephant in the room so far, and now the elephant is going to speak. Well, thank you for both previous interventions, as they have kind of framed the problem. And yeah, we are kind of a solution. I will never say that we are the solution or that we have the perfect solution or something of the like. But first of all, let me please go 2 steps backwards and try to reflect a bit on what risk is. Risk is the composition of 3 factors, which is hazard, which is exposure, and which is vulnerability. So exposure has risen because the population is now tenfold the population of the beginning of the industrial, that it was at the beginning of the Industrial Revolution. In terms of production and in terms of property waiting to be destroyed by a particular hazard, only in the course of the 21st century it has tripled. And since the onset of the Industrial Revolution, it has multiplied 1,000 times, or probably more. And therefore, exposure is a factor that is probably the main driver of the high level of losses that as insurers have to digest somehow. But hazards are also rising. We have already said here that, I'm a meteorologist and I have this deformation of talking about the Clausius-Clapeyron equation, which is a rule that by every degree that the atmosphere heats, there is a 7% more capacity to contain moisture. That is water vapor that is going to precipitate. As we have already reached about 1.3, 1.4 degrees of warming, we have an atmosphere which contains 10% more water vapor inside. Meaning that when it rains more heavily, it rains with bigger hail, it rains with more intensity. So you have also an aggravation of this. And in our geographical position as Europeans as a whole, and as Spaniards in particular, we are sitting on top of a gunpowder barrel, which is the Mediterranean Sea. In the course of the past 20 or 30 years, the sea surface temperatures have risen by 2 degrees, meaning that every time it rains with more intensity, and we see events such as the hailstorm in Milan 2 or 3 years ago, or even burned in the Low Countries and Germany, also in 2023, and of course the Valencia floods, and of course what is happening right today in the Balearic Islands when This weekend we had a passage of a dying cyclone over here in Spain. In Madrid we had a few drops of water at best, and a cloudy day on Sunday. But when it reached the Mediterranean Sea with this ingredient of very hot sea surface temperature, then you have all the ingredients for condensation and for reinforcement of precipitation. And that is happening as I speak. In Ibiza, for instance, and in other places in the Balearic Islands. So we have to count with this another factor. And the third factor is vulnerability, which is composed of two things. Susceptibility, which is the more or less capacity that has an exposed property to be harmed, and also capacity response, which is a societal index saying how societies are adapted and can go back to normal after being hit by a catastrophe. This is where insurance can play the larger role, because if we have a good insurance penetration, then insurance is relevant to cope with this and thus protecting public budgets and alleviating a very important social issue, which is a society completely destroyed by a catastrophe. So, in Spain, we have this arrangement. We turned 70 years old last December, so it's been there. There is nobody alive in the Spanish insurance sector that has not worked with this system. And it is very internalized into the DNA of the Spanish insurance industry. And it is probably one of the, I don't mean to be narcissistic or triumphalist or whatever, but it's probably the most developed public-private partnership insurance-wise in the world. We have a very close and near example and philosophical housing, which is the French system, but we too are based on the binding extension of existing insurance covers, policies, to a certain number of hazards that have to be included in every policy. In Spain, it's flood, it's windstorm, it's some geological hazards, tsunami, earthquake, volcanic eruption, and also human-made factors such as terrorism or civil commotion, for instance. So in every insurance policy, in property, in business interruption, and in personal injury, they have to be included, meaning that we are covering today 144 million policies in the country, of which about 70-something are property policies. That means that automatically every insurance policy in Spain has a dual nature. There are some hazards to be covered by the market. Some of them are natural. All the direct, and Maria Luisa also already mentioned them, hail, rain, snow, windstorms that are not extraordinary, so below the threshold of 120 kilometers per hour. These are market risks. They have to be included, or they are included by the market. The market can apply a free premium depending on where the risk is, and they have this capacity to underwrite those risks. So they have a capacity that we don't have, that they can choose the risks, and they can, as they also have skin in the game, they have this capacity to somehow modify the behavior of the policyholder towards a more resilient approach. But we are extending the cover for the extraordinary hazards by means of the payment of a surcharge who is not risk reflective. It is applied only on the sum insured, and the rate varies according to the kind of risk. It's not the same for a residential property than for an industry or for a commercial property, but everything is included. That means that when we have situations such as the one we had in Valencia about almost a year ago, in which you have like a very big area to the south and west of the metropolitan area of the third city in Spain. As Maria Luisa said, 90% of those properties were insured, and 90% of those properties automatically had flood insurance. And that is a superpower that the Spanish insurance has. In other jurisdictions, flood insurance is something optional. Here it is not, meaning that we have been able to provide an answer. For us, it's going to be about 4.8 billion loss, which is, as I already said, we've been around for 70 years. If you add the top 10 loss events along these 10 years and put them together at current euros, it is less than the Valencia floods. So it's a huge event with more than 250,000 claims, with 144,000 cars affected. In the world, there are 40 countries with less cars than the ones affected in Valencia. And
that gives a measure.
It's a measure, so you can have an idea of the impact of that. And here in Spain, we have a fabric of cooperation with the private sector. So in a matter of, obviously, it was a flood, and it was to be covered by us from scratch. But we have this atmosphere of cooperation with the public sector. And in a matter of 9 days, we reached an agreement with the Spanish Insurance Association so that companies helped us in filing claims, in assessing the claims, and putting the final claims for us to pay, because we are a direct insurer. When there is an extraordinary hazard manifesting into an insured property, it is actually us indemnifying directly to the policyholder. But in this case, we had the cooperation of 38 companies who adhered to the special procedure, and joining forces with the public and the private parts of the insurance in Spain, we have been able today to finish 97.6% of the claims. So in 11 months, which is, I believe, something quite fast in trying to help recover all the tens of thousands of persons affected by this very serious catastrophe. And I think that we have been tested, and I believe that we have kind of been able to provide an answer and to stay around, because we have a very thin line, and we have to find a balance between adverse selection, and that's why we apply this principle of universal mutualization regardless the risk. First, because we are combining non-correlated risks. And if you are living in an 11th floor, it is very hard that you are going to be flooded, but you might be more liable to be affected by a windstorm or by an earthquake, for instance.
I'm actually going to stop you right there, because I have a follow-up question that's specifically on this that I'm going to ask you in a second, but I wanted to ask a question to Bernard first, because it's related to something else you said. So I'm going to come back on that point. And the something else is essentially where the losses end up, right? So we've seen also from Irana's presentation that this is an issue that can have systemic qualities and ultimately affect via contingent liabilities, if they become actual liabilities, also fiscal sustainability, sovereign ratings, and so on and so forth. So I wanted to ask, from your perspective at the ESM, is that relevant? Is that the reason why you're interested in this field, or is there also something else?
No, I think this goes exactly in that direction. I mean, it's one of the challenges that we face is we are looking at the risk from this perspective. Can things become a fiscal challenge to the country so that we have interact with that euro area country? And other aspects are obviously related to the extent that has implications for the financial sector. because the financial sector, as you know, is very interconnected with the sovereign, and as a result you might have this doom loop as we experienced during the great financial crisis, but also in the period thereafter. So those are those two aspects that we are clearly interested in, and those contingent liabilities have an impact on the budget, on the fiscal sustainability of a country, and therefore we are very strongly interested. I mean, if you look at the mandate of our institutions, that essentially says the objective is to helping countries to avoid and to overcome financial crisis and maintain financial stability and prosperity. Now, in this context, it's obviously also clear that we need to look at all sources of risk, and that also includes natural hazards. And we are looking into this from the perspective of the macro aspects, from the fiscal and the financial sector aspects. Now, Irene has already provided a large number of examples, and I don't want to repeat all of them, but if you just take yesterday's newspapers, then you see a lot of articles that go exactly in that direction. So there was an FT article essentially saying that what the European Environment Agency was cited and says that between 2020 and 2023, the losses have been preceding the losses over the last decade. And that's something that is even increasing. And I'm not even talking about climate change here. The sheer fact that we are building in areas where we probably shouldn't, or we have all the development, the socio-economic development of our countries means that if you have an event of similar size, of similar intensity, you will have more losses. If the events even get even bigger, more intense, more frequent, then obviously the losses will even be higher. And this is something, has two implications. First of all, it becomes harder to assess the numbers, and when you look at the figures that you get, be careful not to just interpolate from past figures, but essentially interpret them in line with, do proper forecasting and expect that things might will be rising. And the other thing is that obviously things that might well have looked in the past as something that is easily insurable might suddenly not be, because it is an event that takes place very often. Irene already mentioned an example also. We heard this example of Catalut, where you have those events several times. Now, I come from Austria, I was raised in the area, in the Danube area. Now, there was a flood event in 2002, in 2005, and in 2023 again. It's always affecting the same areas. Now, if you're a regional insurer, that becomes a challenge, because especially when you're regional, you do not really have the opportunity to diversify against other risks. And that is one of the challenges that you face. And we have done a recent research paper that will come out, I think, in December, and where we basically show that if the insurance protection gap is high in a region, that immediately has a highest impact on GDP growth and developments. There's also a paper, and that was the other paper that I was referring to that came out yesterday from the BIS, that also shows the GDP and the inflation impact, so that you need to take into account physical risks in the context of monetary policy, for example. So those are those impacts. Now, I've already mentioned fiscal and the macro side, but then the financial side is also something that we need to take into account, because you might say, well, banking is one thing, insurance something else, but they're highly interlinked. If you want to get a mortgage, usually you need to have you need to have an insurance against that. Now, there are areas in Quebec, for example, in flood-prone areas where it's impossible to get a loan anymore because insurance is not readily available. At the same time, you also see that maybe first of all, banks are hit twice, right? So their collateral is worth less or nothing, and the asset quality, namely the mortgagee, might have to deal with all the losses, so therefore the chances of them being able to repay their losses are also reduced. So you have this double whammy effect that you need to deal with as a bank, so therefore you have the direct impact between insurance and banking. And for that reason, we are also interested in that we see a low protection gap, because the protection gap then, a low protection gap can deal with some of those issues that I was just referring to.
Very clear. I'm going to get back to the question I was mentioning earlier. So you talked about adverse selection, and it's obviously very, very clearly outlined in Bernard's comments, especially also when it comes to underinsurance, in the sense that potentially at the regional level there may not be availability, or at the local level there may not be availability for an insurance contract if there is not a mandate for insurance to insure. But I was wondering, from your perspective as an insurer, where those mandates are coming along and insurance becomes mandatory, and so obviously your exposure increases to these risks. Do you feel there's enough ways to diversify your own risk, be it via reinsurance or via the capital market, or is that part of the reason why potentially we may run into an underinsurance and not be able to completely bridge that coverage gap that we have seen very clearly in both presentations?
Well, we are talking here about the two souls of the Spanish industry. The private insurers have their own tools, which is normally reinsurance. We are not a monolithic way of approaching this. We have a mixed solution. So, the private part is as if Spain was Germany or Britain or wherever. They have the same practices because they have their own risks and they have their own mechanisms to cope with it. And with regards to the public part, well, we have a broader diversification precisely because of the compulsory nature. That means that we have a lot, in spite of having more pressure from the hazards, we are a mattress with 144 million springs, which are the policies that we are covering. So far, and we believe it will be like that for a long time, we have a lot of good risks to compensate for the bad ones. And that's a key element of the Spanish sector and of making compulsory insurance. That if the way that insurance has to protect their portfolios is to exit markets, typical example is Californian wildfires, then is essentially the same. That's saying that the best way to cope with arthritis in your elbow is to chop your arm off, and that's not the best solution. So we want to keep insurance being relevant, and by doing that, well, in the case of Consorcio, we have our philosophy, which is build reserves. So we have more than enough reserves to cope with this extremely heavy loss, and we are still up and running. So it was a significant impact, but it was about a third of our resources, something like that. So
which is still a lot, though.
Which
right?
still a lot, but
for one single event, but I think Bernard would probably argue if the frequency of these events increases and the severity increases, that becomes really challenging.
Yeah, that's precisely what we are here for. We are here for low frequency, high impact events, such as this one, or such as the Lorca earthquake some years ago, or the volcanic eruption at La Palma in 2021. So, obviously not comparable in size and in losses, but we are here not to, we also cover everyday losses, but we are here for this, and yes, we're happy that we could provide an answer without altering the essentials of the system, and we think that the system functioned. But yeah, the idea is to, having these two factors, exposure and hazard going up, the only way to keep the chunk of risk to be swallowed by insurance palatable is to lower vulnerability, and this can be done by raising the take-up rate, by raising penetration, and this is a mechanism. And also by reducing vulnerability. So the idea is that besides providing financial resilience, we can also provide physical resilience. And we do that, private insurers, through premiums, we do that through deductibles, and also through sharing information on loss data with all the administrations that have something to do about building codes, land regulation, etc. So there is an indirect way. It might look like the flat rate is not good enough to cope with risk reduction, but we have a very powerful way, which is sharing loss data and information with the different administrations so that they can apply some measures.
Thank you. So let me maybe first check if there's any questions from the floor, of which there is one already.
Yeah, hi. So basically my question to the panel is, what, if anything, needs to change, right? So I've heard sort of two views, or two. It's been a slightly schizophrenic panel, I think, right? So from Irene at the beginning, we heard that there's a huge insurance gap, and addressing this is going to be really complicated because everything is related. That was the second slide. And, from Bernhard we heard, I think, a somewhat similar message of concern. Then from the Spanish panelists, there's a sense, even though Spain is particularly hard hit, the insurance gap is low, and that has to do with a particular historic arrangement that was introduced for reasons completely unrelated to the current climate-related catastrophe, but turns out to work extremely well. And that arrangement is, if I understand correctly, and today is the first time I heard about it, so I may not understand it correctly, it's basically extend mandatory insurance against climate-related or nature-related risks, or a particular set of risks in every contract, and then you effectively cross-subsidize across those contracts. So you do not force contract holders that are particularly exposed to those risks to pay very large premia, and that way you maintain high insurance rates in areas that are affected. So, one possible policy implication is, if this works so great in Spain, why don't we adopt the same model everywhere in Europe? So that's a question to the non-Spanish panelists. And then, my question to the Spanish panelists is, what is the limits of this model? Because obviously, this works as long as the cross-subsidization is not enormous, which is sort of what you were suggesting, Paco, when you said, these are diversified risks. You're on top of the building, you're bottom of the building, you face a different risk, but you still face the risk. But, once you have real concentration of risks, for example, regionally, which your other remarks suggest is plausible, since the Mediterranean is the powder keg and maybe not the Cantabrian coast. Maybe they have other risks, but maybe not quite those risks. Once you have the Cantabrian coast paying 3 times as high risk premia as they would need to ensure Valencia, probably you will have a problem and you will get to the limits of the model. And then what do you do then? Do you change the model, or do you complement it? Possibly you could then have complementary regulation. You prohibit new buildings in Valencia, something like that, while keeping the model. So maybe both sides of the panel can speak a little bit about this.
Yeah, let's gather a few.
Thank you. I wanted to go back to the point that Francisco made about modifying the behavior of policyholders to reduce their exposure, which is partly what Irene referred to as being charity hazard. So one behavioral problem is people simply not taking out insurance because they assume that the state will bail them out. We see this a lot in the Netherlands, for example, where there's no governmentally funded scheme, but there are these ad hoc, unbudgeted bailouts, literally bailouts. And that obviously has its limits because of the fiscal impact that has, and it will get bigger. But there's also a different problem, which is not so much charity hazard as really real estate hazard. That you can also have responses like the UK, which offers householders flood insurance provided by the state, but not businesses, which is leading to house building in areas that are flood prone. So this is a different kind of hazard, of moral hazard, as it were, where there isn't the incentive to actually for private individuals and indeed property development companies to take into account the risks. So is this something where the proper pricing of private insurance would send an appropriate price signal that would resolve that problem? Is it that the state should not be providing insurance in flood-prone areas, for example, or that it certainly should not be doing it ad hoc? What would be the solution? So this is a more detailed variation on Jeremy's question. It's obviously there's a lot to be learned from the Spanish model, but what would be the model that would modify the behavior of individual economic actors so that they take on the risk that's appropriate to them and they don't take on risk which is, and then expect that somebody else will ultimately bear the consequences?
Just a quick add-on to all of this, to the opposite case, which is Hong Kong. I'm sure there's others. So in Hong Kong, for properties which cost millions, nobody will view any insurance on climate-related issues. Zero. So basically, your gap would be 1. Yeah. And there, you don't have that problem. I mean, basically, you certainly can't calculate the appropriate pricing. But what's happening is that nobody's buying any property anymore. So what I'm saying is that you have all the kind of extreme cases where nothing can be insured. Private sector won't insure. Actually, there's basically no history. I mean, even before all of these problems started, no history of available insurance. Or you get the state to do maybe, if I hear you too much, but what is less costly at the end of the day? And what is less costly? Because you could have a whole hollow out of a city just because nobody's providing the insurance. So, as much as, I feel like there has to be some mandatory insurance at some point in time because the risk is just too high, in my view, no matter reinsurance, you name it. I just don't think that, the private sector can actually, because the most obvious end effect will be nothing. Unless, so, and finally on this vulnerability issue. This is just, maybe this is already out there, but I've never heard of it, so as an idea, we already have all kinds of standards of, energy efficiency. We have laws saying you can't even rent your apartment, 2030 or something, I can't remember the date in Spain. Can you actually come up with, like protection, again, mitigation or other, I would say mitigation, at least in housing, where you pay if you're not ready. If you, in a way, induce people to reduce the risk, basically. So that's kind of in between, the compulsory, but at a different premium depending on how ready you are for that hazard, if that's possible. Yeah.
So I'll be really quick. You heard from me before. Number one, congratulations, Bruegel. We absolutely need insurance companies to talk after banks and companies because, frankly, you seem to know the data. So I've never seen, and congratulations to the Spanish state for having a detailed map that would tell me that if I was buying a property in Catalunya, I'd have to be worried about fire risk. So my question is, does the insurance company talk to the banking sector to provide the information in their databases to the banks who apparently find it incredibly hard to find this information? Anecdote. I know what I'm talking about because I was hired once by the world's largest listed infrastructure company, Ferrovial Group, and we were working through their climate strategy, and they wanted to know about physical climate risk. And until we had a conversation with Munich Re, that was the insurance company who they use globally, we were unable to get the statistics that made the business case to open their eyes to physical climate risk. And so my point is a really simple one. Please, policymakers, when you're being informed by people who apparently find no data and find this also incredibly difficult, let's have a few insurance companies on the panel, or insurers, because apparently, and I think my anecdote was 10 years ago, for many, many years you have been right ahead of this. And to the point on cost, congratulations to the Spanish state. Why? Because your cost of capital is the cost of debt, which Paolo knows perfectly well. Let's call it, flat on bunds these days. And the private sector is not magic at all. The private sector currently increasingly has a cost of capital of the most egregious hedge fund or private equity or sovereign wealth fund. Let me give you a clue, 20% annual returns. What does that mean? Privatize things, you increase the cost of capital, and then most likely you go to a model like in the United States where people can't afford, people who need insurance can't afford it. And the whole point of insurance is mutualization, which is the point that you raised. Thanks.
All right, let me try to sum this up and attribute tasks here. Obvious questions for you: do insurance and talk to the banking system. That was obviously directed at you. For the non-Spanish people on the panel, why does Europe not adopt the Spanish model if it works so well? And I will chip in my own question, which is, what can be done at the EU level? Does EU cooperation on these topics potentially help address the insurance gap that you showed us? Question for the Spanish part of the panel, I would sum this up with, where does the Spanish model break? At what point? And also to Alicia's question, in the continuum between a dead real estate market and moral hazard, with the state subsidizing risks that it shouldn't be subsidizing, where is the optimal point or the optimal trade-off? Who wants to start?
Okay, I will try to answer more or less. I wrote, I think, all the questions, but in general, I think that, of course, it's true that we have a problem, but I think that we are here, and thanks to meetings like this one, we are trying to ease that problem, and we are trying to have a smooth path to a decarbonization economy. So we are here to trying to solve that problems and to trying to having the less possible effects. So I think that that's why we are here. I think that the clue is that we need to increase the financial culture. We need to increase the culture related to insurance. People must know the risks that they are facing, because for sure, well, of course, now in Valencia, they already know unfortunately, the risk of flood. But I'm sure that if we go outside and we ask people, in fact, they don't know the risks that they are facing. So I need that we have to increase that culture, that financial culture and insurance culture. Maybe also, of course, as supervisor, we think that insurance undertakings must have some clear points within the documents that they give to these policyholders, clearly stating them which risks they are covering, which risks not, or if the consortium is going to cover. So I think that also supervisors, people, and also insurance undertakings must have some things to do. But I think that we are here trying to solve, and I think that on a correct way. Of course, prices can increase in specific places, of course, but that's why we need to increase the culture of insurance, because maybe if people realize which risks they are facing, they can include some measures in order to reduce those risks. Also, Paco was talking about, of course, if you live on the ground floor, you're going to have flood risks. Maybe you can include a special door or a special, I don't know. And maybe if you live on the 7th floor, you will need to take some special measures for earthquakes. So increasing culture will help to not solving, because of course the problem is here, but just reducing the problem. That's at least my point of view. Regarding the mandatory insurance, of course, thanks to our mandatory insurance for properties with mortgages, we can, sometimes we don't have some systemic risks, because of course, again, Valencia, with properties we have towns with more than 90% of properties affected. If they have mortgage and they don't have insurance, maybe people are going to leave their mortgages without payment. So maybe you're going to have a systemic risk. So even though it's true that sometimes we need to know exactly if the cost, it worths or not, sometimes we can have a systemic risk that I think that we also need to assess. And regarding the information from insurance undertakings to banks, of course, do you remember that I have included in one slide that we have modified our delegated regulation, and governance was the main topic that has been changed within the insurance undertakings, and they have to include sustainability in their system of governance. And of course, system of governance within the insurance undertakings, they belong to the group. So of course, they have to report all of that information to the banks or to the undertaking. And they will need to give them all the information. And also in our own risk and solvency assessment, they must, it's compulsory, they must have to include some climate change assessment. And if climate change is material, they will need to develop at least 2 scenarios. So of course, the ORSA is going to be presented also to the bank. So for sure, the bank must be informed. Thank you.
Yeah, and also maybe to answer to Jerome, why other countries did not do like Spain? Well, I've not done like Spain yet. So in the last 3 years, I've been involved in working with national central banks and financial supervisors, in particular for insurance and pension funds, and on the topic of physical risk. And with my big surprise, since transition risk is something we are debating now, but natural disasters are something we are already seeing, and we have been seeing so long. So I would have expected all financial regulators tell me, yes, this is material for us. It was actually the opposite. No, we are not exposed to such risk. And you say, well, really? I mean, as it happened in the country like a few months ago. So there is this issue of really disconnect from what's happening, and and also an issue of what are the incentives and governance structure, which is really something on which we should push. So what should European institutions do? Well, look at their governance and the incentives which are in place. So economists, I'm an economist, and we used to like incentives very much, and also conditionality. Well, these are 2 points. So what are the incentives in place so far for financial authorities and regulators to actually carry out their role and challenge the institutions they supervise? Really, really low. So at the national level, they just collect some data from banks and insurance critically and just deliver. No challenge, but which would be also useful for the supervised entities, because sometimes they cannot access data. And here we come to the issue why insurance don't talk to banks. In particular, since in Europe we used to have huge conglomerates of banks and insurance companies, so you are in the same institution. So this is an issue of governance again. And the other point is conditionality of funding. Why other countries did not do like Spain? Well, because a lot of money for post-disaster reconstruction come from common budgets, so safe budget. So governments don't really ask where the money comes from. And in this regard, I mean, there are a lot of lessons from the south of the world where conditionality was applied to access to public funding that could be also constructive in this case. Another point is really thinking, we look at the European level now, they are just going to launch a climate adaptation and resilience strategy in a couple of years. So it will be interesting to understand why we started talking about the EU taxonomy like over a decade ago, while adaptation lagged so much behind. And one of the potential issues is because it's usually considered to be costly to invest in adaptation. last year we explored this topic thinking, okay, but at the same time we are lacking in Europe EU green and safe asset and proposing some solutions for common debt that would also contribute to the development of the capital market union and also saving and investment union. So these are all things that we could explore.
Perfect. So I'm going to
absolutely.
bring this one back to you because it's right in your remit. So.
It kind of is, yeah. No, I think one of the things that when you mentioned to the adaptation is obviously a crucial aspect. I mean, there is one report from the UN Disaster Risk Reduction Office. They basically say that, I think I put it down somewhere, is that every $1 spent in prevention is worth $15 in recovery and $4 in reconstruction of critical infrastructure. Now, if that's, let's take those figures with a pinch of salt, but nevertheless, what it means is it's a good investment. The problem is you need to do the investment first, and you hope that nothing happens, but and this is somewhat related to one of the issues that we face is disaster myopia. That is a crucial problem because I mean, at least in the past, maybe now the situation is changing because the events become more and more frequent, but in the past there was a big event, then there were some attempts to make some changes to the rules and how things work, and then time is passing, and then the interest at the political level gets lost. That is the nature of those things sometimes. So that's something that we need to be aware of. The other thing is why it's important to have insurers, because insurers in that respect can play a critical role. First of all, they can incentivize investments in adaptations through the way they charge premiums. They can, and risk-based premia are essentially also a signal. So if you get rid of risk-based premium, then essentially you don't necessarily know whether you are in a flood-prone area or not, unless you're particularly interested in the topic. But as we know from what Irene said beforehand, there is public awareness is relatively low when it comes to natural hazards. So that's something that there needs to be some additional work in that respect as well. When it comes to the European level, as mentioned before, there has already been some work together between the ECB and IOPA, but also a work between IOPA and ESM, because we're basically looking at the European level, and the diversification that you get at the national level is actually even higher than when you do that at the international or European level, because a flood risk in Ireland is not the same as in Spain. If you then add earthquake risk in Italy to the mix, then obviously you might well get some considerable diversification impact. And that is something, when you can have the opportunity to pool those risks, then this has advantages in terms of the costs of their insurance, and hopefully that will in some form, if the competition is strong enough in the market, then this will trickle down in terms of premium costs as well to the policyholder.
Very clear. So Francesco, you have like the last word, and I think I would probably like you to take on the most difficult question, which is what can be done to change behavior from your perspective?
Yeah, well, first of all, I wanted to answer some of the questions.
Okay, if you want to answer all of them, sure.
To Heather's in particular, charity hazard is not an issue here because if you are insured, you are bound to be indemnified by insurance, but we are not providing public grants, or we are not even using state budgets. We have a separate accounting, we have our own fund paid by all the policyholders, not even by the companies, it's the policyholders who pay, and we have these funds for them. So we take over the role of the private insurer in the same conditions as a private insurer would indemnify the loss. So we don't intervene at all to non-insured properties or persons. So for us, that's not the point. And in terms of why is not everybody doing what we do, well, we are no priests. So we don't have any, as I said, we have a solution, but we have no intention of making proselytism or saying that we are, a new or bigger truth and we want to expand this truth everywhere. No, we are aware that this solution works in Spain. Everybody is accustomed to this mechanism, and during many decades, we were the kind of weirdos in the insurance world. Now, it looks like with this context of increasing losses and increasing protection gaps, we are contemplated in a different way. And every time that somebody asks us how the system is working, we are very happy to explain how our system works here. And that's all. We don't intend to say, hey, you Italians, do what we do. No, we never do that, or even Portuguese, that we share the same geographical context. So we don't have this, that's not our job. But if anybody is wanting to know how our system works, we are happy to honestly explain it to them. Thank you.
Thank you. Thanks everyone for participating in this panel very actively. Thanks to everyone who asked questions. We are sorry for being a little bit late, but it's good because it was because of a lot of questions. So this is it, and thanks for being here today with us.